G'day guys, and welcome to Trader Talk number 4. Thanks for joining me today. And today we're going to be talking about VWAP. So VWAP is the volume weighted average price, and it's an indicator that is used predominantly by stock traders. So let's dig in and let's learn about what VWAP actually is. So VWAP is the amount of shares that are purchased at a given point in time. So what the line represents is basically the average price per share that is held in that intraday time period. So generally you run a VWAP for like a 1 day. At the beginning of the day it will be a little bit more aggressive as less volume is done. Throughout the day the indicator, the line, will smoothen out as more volume is done, and it takes more volume as a percentage to move that particular indicator around. So a couple of ideas around why you would use it. So it can be used generally as a support and resistance tool with intraday trading. This is predominantly used on stocks, but I think you could definitely use it on other markets as well. Though, you do need to make sure that you're getting accurate data in relation to volume for that market. So one that I've used it on and plotted on before is the futures markets, because you know that what is trading through the futures market is predominantly all the volume that is actually trading. There's no sort of other different places where it could be trading, unlike FX, where for example you might do a VWAP with one broker but then other brokers, and there's a lot of other things going on where people are trading different volume in different places. Where it can work in FX is if you do trade it on the futures market, because you can get accurate data from the CME. So what sort of people use it? Well, generally it's people who are stock traders. And there's also a lot of institutions these days who use VWAP related algos when they're putting on large positions. What these algos can do is, say for example somebody wants to buy 100,000 of a stock. They pretty much put it in a VWAP algo, which then buys and sells around the VWAP. So that gives them a fair average price. Instead of just going to market and buying and skewing the price, it actually enables them to get a lot more size on at a better price. So now, for the last part, few ideas of how you can use this in your own trading, and these are some things that I've looked at and different methods of the way I've seen this used before as well. The first one is fading VWAP a number of standard deviations away from the line. So if you think about this from a psychological point of view, what you're doing is, if the majority of people have bought, and this is the average price for the market for that day, and it's a certain amount away from VWAP, generally you might think that people might, the premise behind it will be people covering those positions. And that's where you would get that reversion back to VWAP. Another idea is you might want to trade it through a breakout style of trading, where if you get an aggressive price move through VWAP and a close through it, you might look to see, you know, like a change of trend, a high high or high low, and then a look to move higher on that. So that's another way of doing it. And the third and last way is the break and retest of VWAP, or like a rejection of the VWAP. Sometimes if you think of like a market where, you know, a lot of people are long and the market's sold down very heavily, every time you get a bounce, especially if it's grinded down for the majority of the day, right? Every time you get a bounce, you think of how many people are caught long. And each one of those bounces is going to get to VWAP, and then because that's where the most people are in, you're going to get people scratching or taking a small loss and things like that. So if you VWAP helps you in a way, I guess, think about the particular market and the psychology a little bit more, because if you have an idea where you think people are priced in and where people are bought for today, especially like in terms of like the closing thing, you know, if the stock's been smashed and doesn't want to bounce and it's a very far away from VWAP, and you get a puke because people who are long need to get out, and it really extends down, that could be a, you know, an over session long trade, because you're taking advantage of people having to, you know, get out of the market, get out of those short-term positions, and then, you know, maybe the trade will fling back the next day. But there's a couple of ideas. Obviously there's many ways to skin a cat, but I think there's definitely a lot of different ways that people can use these sort of indicators in the market. Now this is one that I saw a lot around recently, so I was like, you know what, let's dig into this a little bit more and share it with you guys. It's not the be-all and end-all, as no indicator really is, but it's a great indicator to look, especially if you are trading futures or equities, and it might be able to add some insight or something to your trading, give you a different way of viewing things or looking at the market. So that's it for us for this week. Thanks for tuning in again, really do appreciate it. And it's back this week, so if you're heading up to the mountain like I am in the morning, I will see you up there. Have a good week and good trading.